We will catch up during the session. We are planning to run till 12 noon, and then maybe a little longer than that also if the panel discussion requires. So without taking much time, ladies and gentlemen, I would like to invite Mr. Nandika Mudipala, President of the National Chamber of Commerce, for his opening remarks. Thank you.
Thank you very much. Good morning. It's nice to see this much of crowd. When we thought of coming to the market with this kind of the seminar, we thought sometimes there will be less crowd because now most of the seminars had already been taken place. Then even our honorable treasurer, who's senior chartered accountant as well, he also felt sometimes we might run out of people. But can see huge amount of interest. I would like to first of all warmly welcome all of you taking time to come over here. Then I would like to welcome all here, specifically Mr. Nihal Jayawardena, Senior Deputy Commissioner of Inland Revenue, Ms. Priyanka Disabandara, Senior Deputy Commissioner there again, then Mr. KGPK Gunawardena, Senior Commissioner, Customer Support and Promotion. Finally, my colleague Sarah Afkar, tax partner of the video, where we try to come up with maybe so many practical angles of the fiscal proposals as well as implications. Specifically, we are maybe going back to some of the previous procedures what we had earlier. Maybe sometimes some of the procedures are going to be quite new as well. So we know that income tax, withholding tax, advance income tax, VAT, so many things started coming back again, maybe in a bit of different way. Now, when we look at maybe the current situation, we know huge amount of newspaper headlines where the revenue is not going to be sufficient to maybe continue with certain expenditures what we have. But there again, maybe the issue is going to be still the indirect tax, like withholding tax, the VAT is taking a big part of the income. There again, when we look at maybe the interest component, which is for the debt existing, which are honored, specifically rupee debt, there's huge amount of interest payment which is going out as well. And the fiscal deficit, even though it is expected to be maybe 7-8%, maybe estimated figures are running into maybe double-digit 12-13%, maybe sometimes deficit. So we are running into certain difficulties as we are aware. Then maybe when we look at the previous 1 or 2 years where the revenue came down to about 8 to 9%, finally when the revenue came down, the expenditures are not going to get curtailed. So finally, what happens? The ballooning of the debt has been a serious issue. So now the servicing debt also eroding maybe the income levels of the government. So that is the very brief kind of backdrop that we can think of. And I'm not going to touch in the interest of the time. All of us are aware of the macro side of it and what we are going through as well. Then specifically the government expenditure as we speak also is not going to be sufficient. I mean, the government income is not going to be sufficient to pay off the government expenditure. So we are, as usual, running into the fiscal deficit continuously, even for this year, the next year. Expectation is to maybe bridge that gap and to at least keeping aside the interest component, at least to maybe come up with some amount of revenue where the government will be able to meet up with the expenditure. Then huge part of expenditure is for the government servants. Then there again maybe about 43 or 50 billion or something more than when we look at the Samudri and other kind of the expenditures as well. So it is a difficult time. Then the moving forward, how we are going to get into a situation where at least the government expenditure can we meet up with the government revenue is a huge challenge. Then the issue is going to be economy also, like it is expectation of the economy to contract by maybe double digit during this year. There are various expectations for the 2022 supposed to be 7 or 11%. We don't have the figures contraction. So this year there are certain predictions which can be about 1% growth. There are certain predictions which can be about 2% minus growth. There is another prediction where it says it can be 4% minus growth. On the top of that, 11% minus growth or 8% minus growth that we expected during this year. So given that kind of a backdrop, how we are going to increase the revenue for the government is a serious issue. And then when we look at that particular aspect, as well as maybe printing of money, the liquidity issues and other issues, then the economy need to revive. How the economy is going to revive is another serious issue. What I personally believe is what we are facing as far as the inflation and other issues are concerned, those issues are not purely coming out from the demand. We don't have a demand. I mean, we don't have disposable income to spend. So how can we have demand pull inflation? So it is not the demand pull inflation. I think it's supply disruption very much. When we look at manufacturing PMI and when you look at the service PMI, all are below 50. When all are below 50, meaning we have certain issues in the demand side. So the prescriptions what we are trying to use, I'm not going to be critical, but even IMF themselves accepted the fact that these issues are pretty much COVID driven and other kind of issues for throughout the world. We have something more than that as well. When the policy prescriptions of fiscal tightening and the monetary policy tightening, those are there to take care of demand pull inflation. But we have is something else. So we are using policy prescriptions, which may be sometimes not relevant as far as the current situation what we are facing. So I will stop at that point. And when we look at maybe practical issues and practical explanations which are required, we always get the support of the England revenue, because they have the way that they interpret. They are keen in coming voluntarily and speaking to different forum. I think the members who are sitting down here, I don't know how many times that they have sat down for these kind of seminars. And even my colleague Sarah also maybe so many times have sat for different the seminars, but still there is interest. There are clarifications to be made. So you can go ahead with all these clarifications after listening to the presentations. I just glanced through one presentation that they have prepared, very simple manner that they have prepared it. They are technically much more sound than me, but their expectation is to come into a very layman language. They are quite familiar with doing that since they get so many issues and the questions from the audiences as well as the taxpayers and even sometimes non-taxpayers. So thank you very much. There again, I might have to leave for a while because we have about 21, isn't it? 21 the Norwegian students, undergraduates coming here to meet us. So those kind of activities are going to be very, very important for us because there is some amount of interest that we have seen in the recent past. The foreigners are coming down to a certain level, but specifically undergraduates from the Norway coming down is fairly important for us. So need to excuse me. Thank you very much for listening. I will come and join maybe after a while. Thank you very much.
Thank you very much, Mr. Uddipala, for opening remarks. Ladies and gentlemen, in addition to the Inland Revenue officials here at the head table, I would like to acknowledge the presence of Ms. Sarah Afkar, partner, tax BDO partners, chartered accountants, as the key private sector presenter here. And we have Mr. Deepal Nelson, Senior Deputy President of the National Chamber, also at the head table. Ladies and gentlemen, to introduce the Inland Revenue resources Inland Revenue speakers, I would like to invite Mr. Dharmavardhana, KGPK Dharmavardhana, Senior Commissioner, Customer Support and Promotions, to the podium.
First of all, I would like to thank Mr. Secretary General for inviting us for this program, because this is helpful for both as the community and as well as the inland revenue. In the side of inland revenue, the knowledge of the tax system and awareness of the systems will help to increase our compliance rate. Commissioner General's duty is keeping tax compliance rate at a higher level. So these type of programs help to achieve the Commissioner General's targets. Therefore, we are really participating in these type of programs. I representing the customer supporting division. Once this type of request comes from the taxpayer community, Commissioner General refers this request to my division. So my duty is to coordinate these events by the suitable resource persons. So they we are getting this type of requests nowadays because so many changes happening that I can put the segments. So they are getting two resource persons. They have participated in this programs. So programs are they have very experienced officers. Priyanka Disabandara as decades in the service, and Sneha Vijayavardhan has also completed more than 15 years service in revenue. They have worked in this type of activities for a long period of time. And a special thing I have mentioned about them, they were actively involved in the committee level discussions in the evolution of the impact in the 2017 impact. Therefore, they have good idea about the tax law as they have involved from the very beginning of this law. Therefore, I request you to take maximum use of this event. Again, I thank for this chamber for inviting us, and for all of you participating here, and your contribution as a taxpayer in the past for the development of this country. Thank you very much.
We invite the first presentation, Mr. Nehal Vijayavardhan, to start and continue the presentation.
Good morning, everyone. My presentation is focused on Inland Revenue Amendment Act number 45 of 2022. So you will aware that new Inland Revenue Act, that is Act number 24 of 2017, came into operation in Sri Lanka with effect from 1st April 2018. Thereafter, two amendments made to that principal act. One is on 2021, that is Amendment Act number 10 of 2021. So the recent one is Amendment Act number 45 of 2022. So my presentation is focused on the second amendment. Another amendment is also on the way. As you are aware, there are certain budget proposals made in 2023 budget. So there will be another amendment in 2023. So first I have selected withholding tax to be discussed in this forum because this is the area where we receive so much of problems from the taxpayers, because with effect from 1st January 2023, with effect from 1st January 2023, withholding tax has been newly introduced, but certain withholding tax actually, because there were certain withholding tax operated even prior to that amendment act. You know that withholding tax has been introduced with the commencement of the act, and certain withholding tax have been abolished with effect from 31st December 2019. After that, there were certain withholding taxes, but again, compulsory withholding tax deductions introduced with the new Inland Revenue Amendment Act, that is Amendment Act number 45 of 2022. So regarding newly withholding taxes and existing withholding taxes, the Commissioner General has already published 3 types of circulars. These circulars are available in Inland Revenue website. You can go to the Inland Revenue website, and under publication, those 3 circulars are published. One is for deposit interest. You are a bank or a financial institution, and when you are making interest payments to your customer, you have to apply that circular. So it's only representing a part of the withholding tax imposed under section 84(1)(a). The second one is the circular applicable for each and every situation, and third one is applicable for withholding tax on payments to non-resident person. When you are remitting payments to outside person, at the time of you making outward remittances, the third circular is applicable. When you are remitting money outside Sri Lanka, there is a negative list available in that circular. So those payments available under the negative list, you need not to obtain a tax clearance certificate from the Commissioner General. Actually, those are tax exempted or excluded items. But for all other payments, you have to obtain a tax clearance certificate, and then that tax clearance has to be submitted to the bank or financial institution. I mean, for authorized dealers of foreign currencies, including all licensed commercial banks and national savings bank. So when you are remitting foreign currency from Sri Lanka to outside, you have to obtain a tax clearance certificate unless your payment is available in the negative list. So that the third circular will apply for those cases. Whatever the payments which were not covered under circular 1 and 3 is available in circular number 2. So it's available generally for all withholding agents. Now we'll see how you can deduct advance income tax or withholding tax imposed under the Inland Revenue provisions. Even though there are 2 words used in the Act, simply you can identify advance income tax and withholding tax as a one term, that is called withholding tax. According to the provisions of the Act, advance income tax imposed under section 84(a) and withholding tax under section 85. In this presentation, I am not going to discuss about advanced personal income tax because there is a separate section for advanced personal income tax, means paying tax. So advanced income tax imposed under section 84(a) and certain withholding tax still available under section 84. When we are explaining withholding tax provisions, we are clearly identify the difference between section 84(a) and section 85. Because you can see that section 84 and 84(a) applicable for person making payment to any person. So they are you are making payments as a person and to any person. But when you apply in section 85, there it says person make service payment to resident individual. So in this case, section 84 and 84(a), it's applicable for withholding agent called as person and withholding same as person. So withholding agent and withholding both are person. According to the definition of Inland Revenue Act, person not includes Sri Lanka government. Therefore, under Sri Lanka government, government department, ministry office, local authorities, all be considered under Sri Lanka government. Therefore, when they making payments to any person, they don't need to deduct withholding tax because they will not be considered as withholding agent. But suppose that they are receiving payment which is liable to withholding tax. Say a private company making payment to a government department which is liable for withholding tax. In that case, exclusion is applicable because government is exempted from income tax and they have to get a letter from the department. I'll explain later. Then, according to section 84, subsection 3, there are certain exclusions available in withholding tax. So, when you are making payments to a withholdee, if section 84.3 excludes the deduction of withholding tax payment, you need not to deduct withholding tax. So, there are 4 types of cases. One is as a withholding agent, if you are not conducting a business and you are an individual, as an individual not conducting a business, if you are making payment to another person, you need not to deduct withholding tax. For an example, I am not doing any business or business profession or vocation. So, so to use as my resident, I am obtain a house and making a rent payment more than ₹100,000. In that case, I am not capable of complying with the administrative requirements of the withholding tax. Because if I am a withholding agent, I have to register with the department, I have to collect or deduct withholding tax and remit monthly. So those administrative requirements are not applicable for me because of this section. But suppose that I am a person who is conducting a business. Say I am having a shop and I am making rent payment to another person. So in that case, I am an individual who is doing a business and I have to deduct withholding tax on that rent payment. Simply, if you are a withholding tax agent and if you are not doing a business and if you are an individual, you need not to deduct withholding tax. But if you are an individual who is doing a business, you have to deduct withholding tax subject to the other provision. But in the hands of withholdee, this is only an exclusion, not an exemption. Therefore, in the hands of withholdee, whether withholding tax deducted by the withholding agent or not, relevant withholdee has to include that rent or the withholding subjective payment as part of their taxable income and they have to make tax payments. Second one is it says person making loan interest payment. That loan should be an ordinary loan issued by a financial institution. If explain this one, say I am a person, I am a company, and I am making loan payment to a bank. So bank has granted loan payment to loan for me, and I am making a installment payment to the bank. So in that installment, I am having capital payment plus interest payment. So I am the withholding agent in that case, I am making interest payment to the bank. Generally, it's liable for withholding tax, but due to this exclusion, I am making interest payment as a part of the ordinary loan granted by the financial institution. Therefore, I am not required to deduct withholding tax. But suppose that I am a company and making this loan payment to another company which is not a bank or financial institution.
Sorry to disturb you. The vehicle number CBJ 6383 was just parked near the chamber outside, it had to be removed very quickly. The vehicle owner is here, please. CVJ 6388. Thank you.
So when it comes to second one, as I said, if I am a company and making loan payment to another company, which is not a bank or financial institution, and make interest payment. So in that case, I have to deduct withholding tax because I am not making interest payment to ordinary loan issued by a financial institution. Say I am an individual and I am doing a business and I obtain a loan from another individual. So in that case, say I am making interest payment, I have to deduct withholding tax because I am an individual who is doing a business, not doing not conducting business. It's not, the first one is not applicable in that case. So likewise, you have to consider the second exclusion. The third one is applicable only for treasury bills and treasury bonds issued by the Central Bank of Sri Lanka on behalf of the government of Sri Lanka. Prior to 1st April 2018, when they issuing treasury bills and bonds, they have deducted withholding tax upfront and notional tax credit allowed for taxpayer. But with the introduction of new Inland Revenue Act, now they are not deducting withholding tax on treasury bills and treasury bonds, interest or discount on treasury bills and treasury bonds. But when you are making income tax payment, the discount or interest received or derived on such treasury bills and bonds are liable to income tax, and therefore you have to include those interest and discount as a part of your taxable income and then make payments on installment or assessment, not as withholding tax. The final one is when you are making a payment to a withholdee and in the hands of withholdee, such payment is exempted, then you need not to deduct withholding tax. So in my first slide, I have explained there are 3 circulars. So in those 3 circulars, there are certain exempted items available. If you are making payments for those items, you need not to deduct withholding tax. In circular themselves, it says you need not to deduct withholding tax on given exempted amount. But other than those mentioned items, there are exemption available for taxpayers under the provision of Section 9 and 3rd Schedule to the Inland Revenue Act and according to the Transitional Gazette published in 2018. So those cases, circulars answered and say you have to obtain a confirmation letter from the department, and based on the confirmation letter, withholding agent can act on the deduction of withholding tax. Say if you are, as I said, a government department is exempted from income tax, but there are certain funds and projects available under government, so they are not qualifying for that exemption. Similarly, say public corporation is not coming under the government, but the certain public corporation also exempted based on the law that they have established. So those cases have to be verified by the Commissioner General and should issue a letter. That withholding, I mean those government entity has to come to the department and obtain that letter, and that letter should be submitted to the withholding agent, and based on that letter, withholding agent can exclude the deduction of withholding tax under this provision. Say if you are conducting a welfare society as defined in the Inland Revenue Act, and you receive interest from a bank or financial institution, you have to come to the department and show that you are a welfare society and entitled for this interest exemption. Depend on your facts, department will issue a letter confirming your interest is exempted, but it's not applicable for other sources. Say welfare society receives rent income. In that case, department letter will focus only for interest, not for rent. So that letter you can submit to the bank or financial institution and can ask to avoid the withholding tax deduction. But that letter you can't submit to the person who is paying rent, and that the person who paying rent has to be deducted withholding tax because it's applicable only for interest. Similarly, there are certain BOI exempted companies. They also get entitled to get this letter, not applicable for lower rates and turnover based company, but it's applicable only for exempted company. Depend on the year of assessment and the nature of income, department will issue this letter. From the exclusions, I am moving to the income item and tax rate. So there we have duly introduced withholding provisions and payments available prior to Amendment Act number 45 of 2022. First one is available from the commencement of the Act. When you are making payment to non-resident person in respect of air or sea transport, based on the Gazette notification issued by the Commissioner General, tax rate has been given. The tax rate is 2%. So it's not a new one, it's a previous one without any amendment. Second one is also not a new one. There it says sale price paying by the National Gem and Jewellery Authority for the auctions that they are conducting. They deduct at 2.5 rate of withholding tax on the sale price, and once they deduct that withholding tax and the balance proceed received to you is exempted according to the provisions of Penal Revenue Act. So the second one is also not a new one, it's coming from 1st April 2018. The third one is the mandatory deduction introduced with effect from 1st January 2023. That is interest or discount paid by a person and the rate is 5%. So this withholding tax or advance income tax introduced mandatorily with effect from 1st January 2023. If you are making interest payment, as I explained earlier, you have to deduct withholding tax. Prior to 31st December 2019, interest received by individual considered as a final withholding payment. You know that according to Section 2 of the Inland Revenue Act, there are two types of income tax payment. One is you have to pay income tax on taxable income. Second one is you have to pay tax on final withholding payment. If you are making tax payment on final withholding payment, you are not entitled to deduct a tax-free allowance. At the source, sometimes withholding tax will be collected. If not, you have to make payments for such amounts at the rate of withholding tax, not as a tax on taxable income. So prior to 31st December 2019, interest derived by individual considered as a final withholding payment, but from this amendment, interest received by resident individuals not considered as a final withholding payment. Therefore, as individual, if you derive interest income on or after 1st January 2023, your withholding agent will deduct 5% withholding tax, and that interest amount you have to include in computing your taxable income, and 5% withholding tax will be allowed as a tax credit. Say if your taxable income is less than 1.2 million, in that case, you are entitled to claim a refund. Similarly, if your taxable income is taxed at higher rate, you will have to pay tax on applicable tax rate. So it's not a final. The next one is rent payment to resident person. If you are making rent payment to a resident person and monthly rent payment is not exceeding rupees 100,000, you will have to deduct 10% withholding tax. They are actually, Inner Revenue Amendment Act is having a problem because it says if your rent income is not exceeding 100,000, applicable rate is 0%. And again, it says if your rent income, if your rent payment is equal to 100,000 or exceed 100,000, tax rate is 10%. So benefit has to be granted to the taxpayer. Therefore, if your rent payment for a month is exactly 100,000 without exceeding, you can apply the most favorable rate, that is 0%. If your rent payment for a month is rupees 100,000 plus amount, you have to deduct withholding tax at 10%. So this rent 10% withholding tax and this ceiling is applicable only for residents. If you are making rent payment to a non-resident person, applicable withholding tax rate is 14%. Regarding the rent payment, you have to carefully check whether you are making rent payment or service payment. I am taking some time to explain this withholding tax provision, I think, because it's very important. Sometimes you may aware that there are so many assessments issued by the department for year of assessment 2018-19, because taxpayers has not correctly deducted withholding tax according to the provision, and based on the section 10(2) of the Inner Revenue Act, there are so many assessments issued by disallowing the relevant payment for withholding agent. Therefore, as a withholding agent, according to the provisions of that, you and withholdee having responsibility to comply with withholding taxes. Most probably you may receive no assessment if you are not correctly deduct withholding tax. Therefore, I think it's important to identify these withholding tax provisions clearly and comply to the law. When you are making rent payment, as I said, rent payment is not limited to immovable properties. According to the definition available in section 195, it's covered movable and all immovable properties. For an example, if you are making rent payment in respect of a vehicle or a machinery, you have to deduct withholding tax subject to these conditions. I mean, say if you are making payment less than 100,000, you need to deduct withholding tax. So in identifying a particular payment as a rent or as a service payment like transport or higher charges, there is a public ruling issued by the department and available in Inner Revenue website. The department, the implementation committee has given certain example. Depend on the certain facts, you can decide whether you are making rent payment or service payment. But there we are focusing the fact whether you receive the control of the relevant property or not. Say if you obtain a vehicle and you didn't receive control of the vehicle, but they are simply providing a service, transport service. Say I am obtaining a vehicle from a supplier and fuel, driver, everything provided by the relevant supplier, not by me. So in that case, most probably control is with them and it's a service payment. But some people providing a vehicle to me and I am using my drivers and vehicle fuel, and I can use vehicle according to my objectives. So therefore, it's a rent payment. Sometimes you can put your stickers and other things in vehicles. So in that case, control is available to the person who obtained. Likewise, there are examples available in that public ruling. If you are having doubts, please follow that public ruling and consider whether you are making payment as a rent or a service payment. Because rent is liable to withholding tax, but service payments like hire charges and transport charges are not liable for withholding tax. Then the final item under section 84 and 84(1)(a), that is for rent payments to non-resident person. As I said, the rate is different. Tax rate is 14%. Whether the non-resident person is a citizen or a non-citizen, you have to deduct 14% withholding tax. Actually, it's not a new amendment because it's available prior to the amendment under section 85. Then charges, natural resource payment, royalty, premium, or winning from a lottery, betting or gambling. So those payments also subject to tax under 14% withholding tax. For natural resource payment and royalty also there are definition. When you are making those type of payment, you can refer section 195 of the Inner Revenue Act and see whether you are making payment of natural resource payment or royalty. If so, you have to deduct withholding tax. Winning from a lottery more exceeding rupees 500,000, relevant lottery board or development lottery board will deduct 14% withholding tax, and if the winning amount is less than 500,000, it's exempted. Then I am moving to the second withholding tax provision, that is section 85. Section 85, this one I have already explained. Here you can see that section 84(a) says person makes payment to another person, but here person makes service payment to a resident individual. So basically, other than the second item, it focuses on the service payment you are making as a person to a resident individual. So simply section 85, this service payment withholding tax deductions is not applicable when you are making payments to a company, partnership or other entities. Here too also, government, you need not to deduct withholding tax under section 85. Second one is applicable for non-resident. This one is also available from 1st April 2018 without any change. If you are making insurance premium or service payment to a non-resident person, subject to withholding tax at 14%. So there we have service payment liable under section 85. It says there you can see 3 items available. One is for teaching, lecturing, examining, supervising and examination. So first one is that part. Second one is commission or brokerage to a resident insurance canvassing agent. So second, you have to identify this payment as a second one. Third one, it says services provided by an individual in the capacity of independent service provider, such as doctor, engineer, accountant, lawyer, supervisor of an academic. So the available professionals you have to consider. But there you can see that I have part of the section there. It says or any independent service provider as may be prescribed by the minister, because at this moment Commissioner General has not gazetted independent service providers which should be subject to withholding tax under this provision. And at this moment there is no intention to gazette those professionals or other individual service providers. So you have to deduct withholding tax only from these 3 sources. From 1st April 2018 to 31st December 2019, we have administered withholding tax under section 85. According to that provision, Minister received the power to prescribe any other matters for withholding tax purpose, and thereby gazette has been published, and according to that gazette, construction services, janitorial services, security services, catering services and certain management services covered. You have deducted withholding tax when you are making payments to an individual person for these payments as well. But from this amendment, scope of the gazette has been limited to certain items. And now gazette is also not there. The previous gazette, we can't apply for this one because this section itself, it says with effect from 1st January 2023, this has been imposed. Therefore, we can't apply the prior gazette issued prior to that date, I mean 1st January 2023. So since we don't have any gazette notification, your deduction should be limited to these 3 items. If government is in an intention to issue a gazette notification under the power of this section, Commissioner General, the department will inform to the taxpayers to deduct withholding tax available under that gazette. Therefore, at this moment, you don't want to worry about the gazetting requirement. Limit your withholding tax deduction under this section only to these 3 items. And there also, you have to deduct withholding tax only professionals like doctor, engineer, accountant, lawyer, software developer, researcher or academic, not from other professionals. Say here, it does not say that you have to deduct withholding tax from a valuer. Actually, if we provide the name of valuer here, it's very difficult because there are valuers who are providing valuation for lands and building, and say gem and jewelry, another type of valuer should be required. For shares, another type of valuers. Likewise, it's complicating. Therefore, your deduction should be limited to these professionals and the above 2 items. Applicable withholding tax rate is 5%. And if you are making monthly payment more than rupees 100,000, you have to deduct withholding tax. If not, you need not to deduct. So that was the position after the amendment of section 85. Then if you are making insurance or service payment, as I said, at the rate of 14%, you have to deduct withholding tax from the payments to non-resident person. Certain exclusions available in section 85(3) as well. So those 2 items I have discussed under section 84. Here too, it says as an individual who is not doing a business, you need not to deduct withholding tax, and withholding derives income exempted according to the provisions of law, then withholding can get the exclusion, as I explained, according to the procedure available in the circulars. After withholding tax provision, I am moving to discuss about the final withholding tax payment. So I have explained how we collecting withholding final tax on with final withholding payments. Section 88 listed 4 items for final withholding payments after the amendment. So here this slide incorporated all final withholding payment prior to the amendment and after the amendment. The 4th one is the one available after the amendment, and the first 3 items available prior to Amendment Act number 45 of 2022. First one is winning from a lottery. As I explained, 14% withholding tax will be deducted by deducting by the lottery board or development lottery board, and thereafter it's a final withholding payment, and there is no further tax on those receipts. It's available not only for lottery receipt, betting and gambling winning also there. The second one is payments made to a non-resident person and a non-citizen and non-resident person. So whatever the payment that they received, other than through a Sri Lanka permanent establishment, we will consider as final withholding payment. Because basically non-resident and non-citizens deriving these type of payments as passive sources of income. Therefore, we can't maintain tax file for them unless they are having a permanent establishment in Sri Lanka. Therefore, we collect their tax as a final withholding tax payment. Third item is available for non-resident citizens in Sri Lanka. There are Sri Lankan citizens who are having income like rent, dividend, interest from Sri Lanka. But this final withholding tax provision is applicable only for interest income. If non-resident and citizen derives interest from Sri Lanka, subject to the deduction of tax-free allowance, I mean 1.2 after the amendment, they can consider interest as final withholding payment. So this is a benefit for them because based on the newly introduced tax rates. They can compute their tax liability through their agent and submit returns. And if there's any excess, they can claim as a refund. Final one, as I said, introduced with effect from 1st January 2023 for dividend declared by resident companies. If prior to 31st December 2019, same was there, and after removing withholding tax on dividend, dividend we have considered as part of the taxable income, and 14% tax rate was there for company, and for others, it's individuals, it's taxed under progressive rate. But after these changes, after January 1st, 2023, dividend received by individual or companies treating as final withholding payment, and resident company, if there is no exemption, has to deduct 15% withholding tax on dividend payment. So those are the withholding tax provisions I have to discuss in this forum, because these withholding tax provision I have selected to be discussed at first because of the importance at this moment. And as I said, I think it's better to focus on the correct deduction of withholding tax according to the section 10 and 10(2) provision. Otherwise, your deduction will be assessed by the officers of the department. Then I am moving to discuss about the rate changes introduced with effect from introduced from the Amendment Act number 45 of 2022. First, we will see what are the reliefs changed from the Amendment Act. Personal relief or tax-free allowance, you know, it's allowable for resident or residents and non-resident citizen individuals. This rate, this personal relief has been changed with effect from 1st January 2023. After 3 quarters of the year of assessment 2022-23, change has been introduced. Therefore, first 9 months of the year of assessment 2022-23 will be taxed. Actually, the taxing rule will be applicable according to the amendment prior to 31st December 2022, and new amendment will be applicable only for the remaining 3 months period. So first 9 months of the year of assessment 2022-23, available personal relief is rupees 2,250,000. Because according to 2021 Inland Revenue Amendment Act number 10, personal relief has been introduced, increased to rupees 3 million. You know that currently the 2021-22 personal relief is rupees 3 million. So 3/4 of the personal relief available prior to this amendment granted for first 9 months, and newly introduced personal relief is only rupees 1.2. 1/4 of that amount considered for second 3 months. Therefore, your 2022-23 first 9 month personal relief is rupees 2,250,000, and second 3 months personal relief is only rupees 300,000. And thereafter, from 2023-24 onwards, your normal personal relief for tax-free allowance is only rupees 1.2 million. Then expenditure relief. This has been introduced with effect from 1st January 2022, and now it's closed with effect from 31st December 2022. There are 9 months available for 2022-23 year of assessment. For first 9 months of the year of assessment 2022-23, 3/4 has been granted, that is 900,000. If your actual expenditure incurred, which qualified under expenditure relief, you can claim subject to the maximum limit of rupees 900,000. There are items, you know, that educational expenses incurred by the taxpayer on behalf of his children locally, and certain medical expenses of the taxpayer and medical insurance premium, housing loan interest, contribution to a pension scheme, and certain investment for treasury bill, treasury bond, and quoted debt securities or equity securities qualified for expenditure relief. Actual expenses incurred during the first 9 months subject to 900,000, you can deduct under expenditure relief only for 2022-23 year of assessment. Thereafter, there is no expenditure relief. So these are the two major changes made to reliefs available in the Revenue Act. So still there are another 2 types of reliefs available in Act. That is, one is solar panel relief. You know that this has been introduced with effect from 1st April 2021. If you are fixed a solar panel in your premises and connected with the national grid, whether you finance that solar panel acquisition through a loan, then your loan capital and interest will be considered for the solar panel relief. If not, if you purchased a solar panel, that purchase cost will be considered for solar panel relief. Subject to maximum limit of rupees 600,000, you can deduct this this solar panel relief. So this is available not only for 2022-23, thereafter also you can invest on solar panel according to the provisions, and you can claim the deduction. The 4th one is for rent. There is a 25% of allowance. It's not a new thing. It's coming from 1st April 2018 and available without any change. Now we'll see what are the rate changes made. As I said, prior to this amendment, tax slabs were there. Rupees 3 million, first 3 million tax rate is 6%, second 3 million 12%, and balance 18%. Since the changes for individual made after 9 months period of the year of assessment 2022-23, first 9 months period, first 2,250,000 will be taxed at 6%, next 2,250,000 will be taxed at 12%, balance tax at 18%. So thereafter 500,000 equal tax slabs introduced, and tax rates are 6%, 12%, 18%, 24%, 30%, and balance taxed at 36%. Accordingly, 1/4 has been taken for 2022-23 second 3 months period. Therefore, 125,000 each slabs are there. First 125,000 tax rate is 6%, next 125,000, 12%, likewise 18%, 24%, 30%, and balance tax rate is 36%. So after 2023-24, individual normal tax rates, progressive normal tax rates are first 500,000, 6%, next 500,000, 12%. Likewise, tax rates are applicable. Then we will see what are the company tax rate changes. So from the commencement of the act, there are concessionary tax rate, actually special tax rates available in paragraph 4 of the first schedule to the Inland Revenue Act. So from the Amendment Act number 10 of 2021, certain other items also included to those special tax rates. Now those special tax rate, the concessionary tax rate, have been removed with effect from 1st October 2022. Therefore, company tax rate changes made after 6 months of the year of assessment 2022-23. Accordingly, first 6 months will be taxed according to the provisions prior to this amendment, and second 6 month period will be taxed at after the amended provision. So the concessionary rates still available in the year of assessment 2023-23, but only for first 6 month period. From the 1st October 2023, all concessionary tax rates are removed, and now there is only 2 company tax rates. One is normal company tax rate of 30% and liquor, betting and tobacco tax rate, that is 40%. So those are the 2 tax rates available after the amendment. Prior to the amendment, SME business tax rate was 14%. It's available only up to 30th September 2022, which means only for first 6 month period. Export of goods, specified undertaking, educational services, construction services, healthcare services. So all were taxed under concession rate, and those rates change. Then you know that from 2021 amendment with effect from 1st April 2019, agriculture sector for agro farming, an exemption has been granted for a 5 years period. Agro farming exempted for 5 years period commencing from the year of assessment 1920. So that 5 years will expire automatically from next year of assessment. From 2023-24, it's automatically expired. Therefore, no change has been made for this agriculture exemption. But as a consequential change, another concessionary tax rate granted for agro processing, that tax rate effective only for first 6 months of the year of assessment 2022-23. Still, you can claim the agro farming exemption for 22-23 and 23-24, but agro processing concessionary tax rate available only for first 6 months of the year of assessment 2022-23. Then dividend tax rate, I have explained prior to 31st December 2019, it was a final withholding payment, and thereafter subject to other exemption. Dividend has to be included as a part of your taxable income, and there was a concessionary tax rate for companies. So that tax rate is also available up to 30th September 2022. Now there is a gap in both Inland Revenue Amendment Act number 10 of 2021 and 45 of 2022. That gap is available only for 3 months period from 1st October 2022 to 31st December 2022. During that period, there is no particular tax rate which should be taxed the dividend derived by a person. For non-resident person also, there is a matter. So those gaps have been answered through the technical note available in the budget proposals 2023. According to that technical note, dividend derived by you from 1st October 2022 to 31st December 2022 will be taxed at 15% as a flat rate for individuals and companies. Same 15% tax rate has been granted through that proposal. So that proposal will be incorporated in next amendment, and you can apply that tax rate for this 3 months period, and thereafter it's a final withholding payment and applicable rate is 15%. Another concession rate granted from 1st April 2021, considering the COVID situation. So that concession rate is also removed with effect on 30th September 2022. And as I said, general 30% tax rate is applicable thereafter. Manufacturing 18% tax rate was there. That is also available only for first 6 months of the year of assessment 2022-23. Then the next tax rate has not been changed. As I said, it's available for conducting betting and gaming or manufacture and sale or import and sale of any liquor or tobacco product. If you are deriving gains and profit from these businesses, applicable tax rate is 40%. This 40% tax rate is available for 2022-23 and thereafter without any change. As another concessionary tax rate introduced from 1st April 2021 for supply of electricity using renewable energy resources and for gem and jewelry sector, and the rate is 14%. That tax rate available for individual as a maximum rate. Individuals prior to this amendment supposed to tax at 6%, 12%, 18%. So first they can apply 6%, 12%, and this maximum rate they can apply for gains and profit from these two businesses. So this change done for individual with effect from 1st January 2023 onward. Therefore, if individual derives gains and profit from electricity generated under renewable energy resources or from gems and jewelry, they are having this maximum 14% tax rate up to 31st December 2022. But for companies, it's applicable only for first 6 month period of the year of assessment. Then capital gain tax rate has been changed only for companies, and rate change applicable from 1st October 2022. Prior to change, applicable tax rate is 10% for all person, individual and entities. But now, only for companies defined in section 195, applicable rate is 30%. Still, individuals and other entities, other than there are certain entities not coming under the company definition of that. So those entities, capital gain tax rate has not been changed. So tax rate is for companies, it's 30% from 1st October 2022. Then normal tax rate is 30%. It's an increase compared to the rate 20%, 24% rate prior to amendment. Another two types of concessions introduced from 2021 amendment. That is, the first one is introduced to promote the listing in Colombo Stock Exchange. If you have list your shares in Colombo Stock Exchange during the year 2021, you receive a benefit of 50% tax reduction during the year of assessment 2021-22, and maximum rate of 14% available up to 3 years. So this also has been closed with effect from 1st October 2022. You have already enjoyed that 50% reduction, but 14% lower rate available only up to 30th September 2022. Then another concession granted for multinational company, if they increase their export by 50%, no, sorry, if they export their, increase their export by 30%, they are receiving certain benefit for their dividend income. So that was a reduction of tax in first year of assessment and balanced years of assessment. So up to 30th September 2022, this concession is available, and up to first 6 months, tax rate is 7%, because normal dividend tax rate is 14%. 50% will be reduced due to this concession. Applicable rate is 7%, and thereafter this concession is also not available. All the sector-specific concessionary tax rates and exemptions removed from this Inland Revenue Amendment Act. Now I am moving to discuss about the tax rates of other entities. Trust tax rate is prior to amendment 18%. Normally, trust income tax rate, we are taking highest rate of the individual. So prior to 31st December 2019, the rate was 24. With the reduction of individual tax rate, it reduced to 18%. Now it has to be increased to 36%. But Act increase only up to 30%. Therefore, normal trust income tax rate for first 6 months of the year of assessment 2022-23 is 18%, and for second 6 months it's only 30%, and thereafter also trust income tax rate is 30%. Unit trust or mutual fund tax rate is 24% prior to the amendment, and it changed to 30%. But practically this one is not applicable, because this rate is applicable when you are doing as a unit trust. If you are not doing an eligible business, this rate is applicable. Practically all unit trust available in Sri Lanka doing eligible business. Therefore, the pass-through provisions they can apply, and relevant rates will apply accordingly. Charitable institution tax rate never changed from the commencement of the Act. 14% rate available without any change. NGO tax rate changed prior to the amendment. For first 6 months of the year as amendment 2022-23 is 24%, and thereafter it's 30%. Employee trust fund, provident fund, pension fund, gratuity fund, and termination fund related tax rate also never changed. It's 14% without any change. This 14% tax rate coming from the Act introduced 1st April 2018. Then partnership tax provision also not changed from the Inland Revenue Amendment Act number 45 of 2022. Therefore, changes introduced from the previous amendment, that is 2021, applicable for this years and future years. So you know that partnership also have to compute their taxable income with effect from 1st January 2020. Their first 1 million will be taxed at 0%. Therefore, there is no tax for first 1 million of the taxable income, and thereafter tax rate is 6%. Whatever the tax that the partnership has been paid, you can distribute among the partners according to the income sharing ratio, and thereafter in the hands of partners it's a tax credit, and if there is any excess, partners can carry forward relevant partnership tax credit to next year and can deduct, but thereafter they can't carry it forward. So those are the rate changes and relief changes introduced from the Inland Revenue Amendment Act number 45 of 2022. Now I am moving to discuss briefly about the other changes. As far as deduction rules are concerned, there was a matter regarding the application of section 14, that is for repair and improvement of depreciable asset. Prior to 2021, there were so many practical difficulties. Accordingly, repair has been removed from the section 14. Now, with effect from 1st April 2021, you have to restrict it only improvement expenditure. You can deduct repair expenditure under the provision of section 11. Section 14, the deduction restriction is applicable only for improvement. Now there was a matter when your tax depreciable asset is zero, value is zero. Say you are having a machine and you acquired that machine prior to 10 years and your tax depreciated value is zero. In such cases, there is no basis to allow your improvement cost in section 14. So that matter has been answered through this amendment. Now, for building and related asset, there is a period of 12 years, and for other asset, it's 3 years. So whatever the improvement cost, you have to absorb for 12 years, and each equal amount you can claim for each year of assessment within the 12 years period for building and related asset. But for other asset, you have to split that amount into 3 parts, and one by one you can claim within 3 years of assessment. It's done. This change has been done to improve the clarity and to solve your practical problems. The second one is also to improve the clarity, because you know that there is a thin capitalization rule. We call it as a thin capitalization, but it's restriction of financial cost deduction under section 18. There are in sometimes your financial cost deduction will be limited to the formula provided by the section 18, and if there is any excess, you have to carry it forward to next year. But suppose that in a particular year of assessment, you are having brought forward financial costs which were disallowed in previous year, and during that year, if you are not having any amount of financial cost, you can't compute the limitation, because subject to the limitation, you are allowed to deduct brought forward income tax, brought forward financial cost. Suppose that in year of assessment 2030-31, you are having brought forward income tax, brought forward financial cost, but there is no financial cost incurred in that year of assessment. So in that case, you can't compute the limitation. So this rule provides a basis. You have to go to the prior year limitation and can deduct the financial cost. If prior year base is also not available, then you can go to the immediately prior year. Likewise, you can deduct financial cost. Practically, this type of case may also very rare, but if there is anything, we have to provide a solution. So this amendment facilitated it. The third deduction rule change is for marketing and communication expenses. You know that with effect from 1st April 2021, double deduction has been granted under section 15A for marketing and communication. Sorry, 6th schedule for marketing and communication expenses listed under section 15A. This deduction, the double deduction available for 3 years of assessment, 21-22, 22-23, and 23-24. Those 3 years, subject to the conditions and according to the Gazette notification, you can deduct double deduction. Maximum ceiling is rupees 500 million. So this double deduction limited to 2 years. Therefore, for this year of assessment as well, For 2022-23 also, you can deduct this double deduction, and but it's not available for next year of assessment. Anyway, section 15A rule is available. There you can deduct capital nature marketing and communication expenses even after these changes. Then, as I explained, lower tax rate increase from this amendment. Therefore, there is a matter according to section 19, you can't deduct lower rate losses from higher rate profit. They are considering that rule. This change has been introduced because Act itself increased the lower rate to higher rate. Therefore, if the prior portion is there, you can't deduct lower rate losses again higher rate. So now a solution has been provided through the Act. If the rate has been changed due to the statutory change, you are allowed to deduct lower rate losses again higher rate profit. Then a change has been made to the second schedule. It's to facilitate your investment because according to section 2, enhanced capital allowances granted as investment incentive. So if your new investment is more than $3 million, you are eligible to deduct enhanced capital allowances under the provisions of the second schedule. There actually we had problem because taxpayers are not possible to invest their total amounts within the year of assessment. According to the provision, they can't defer their claimability of enhanced capital allowance to next year. So there is a matter because sometimes they can't complete the investment requirement. Sometimes after the period of implementation, they might incur certain investment amounts. So considering all things, a project implementation period has been granted. Now the Act provided a 3-year period to invest your prospective investment amount. After complete your investment amount, within the 3 years period, you can deduct this enhanced capital allowance. Say, second year you have completed your total investment and you are eligible to deduct enhanced capital allowance. So based on this provision, you can claim it second year. First year, second year, or third year, depend on the conditions, you can claim this enhanced capital allowance. Then certain administrative provisions also change. Actually, the first one is introduced considering the changes prior to the new ones. I mean, prior to 31st December 2022, APIT is not, deduction of APIT is not mandatory for resident citizen individual. So in that case also there are taxpayers who wanted to pay their due tax through the APIT and they don't seek any expenditure relief for qualifying payment or other benefit, and they want to remove their tax filing requirement. Considering their request, this change has been introduced. Accordingly, now also if your total tax liability settled through the withholding scheme, I mean, if you are an employee, and your employer deduct all your tax due amount through the APIT system, and if you are not having any other income or other tax payment, you can simply avoid the tax filing requirement. But for this year as well, most of the taxpayers are having expenditure relief benefit, and even after that, there are qualifying payment, there are solar panel relief. So if you wish to obtain this benefit, you can ask to close your file. If not, still you can submit return, and there's any refund you can claim. Then another change has been made from the previous amendment. According to the previous amendment, there were certain exemptions and concessional rate. So in order to identify particular gains and the relevant gains and profit for relevant business or investment activities, separate financial statement requirement has been introduced to Section 120 of the Inner Revenue Act. So that has that provision created certain matters for taxpayers because there are expenses and assets used commonly. Therefore, they are required a basis to prepare their separate financial statement. So through this one, a proportionate base according to the turnover, you can split the commonly incurred expenses or commonly used assets and you can consider those deductions according to the turnover basis. This financial statement should not be, it's not a requirement of, the requirement is not having audited financial statement. You can simply prepare separate financial statements to identify each profit, gains and profit and could submit. And this method is also you can use if you wish to obtain that benefit. Then the change has been made to Section 136. If you originally submit your return of income prior to this amendment, 30 months of time bar period was available, and within that 30 months of time bar period, you are eligible to provide an amended assessment, amended self-assessment return. Say if you found that any error from the previous return, you can allow to submit a amended self-assessment. The previous question is within a 30 months period you have to submit it, but now it's reduced to 12 months. Within a 12 months period you have to provide a amended self-assessment return. Then I am moving to discuss about the exemption. Actually, exemptions, there are only one exemption. All the others are removals actually. No, not new exemption. We'll see what are the removed expenses, but first one is available only for government entities. There are certain loss-making government entities and they want to transfer their assets to another government entity, 100% owned government entity. In order to facilitate this transfer, because there is no cash flow between person from one person to another person, in order to facilitate these transfers, this exemption has been granted for capital gains and business gain. Thereafter, as I said, exemption removal available. First one is applicable with effect from 1st October 2022. All the others applicable with effect from 1st April 2023. First and second one is for Sri Lanka REIT investment, Sri Lanka Real Estate Trust investment. In order to facilitate these businesses, government has granted these two exemptions based on the budget proposal 2021. Accordingly, if you are transfer your land or building to a Sri Lanka REIT, capital or business gain derived by you considered as an exempted amount, but that exemption removed. Then dividends, gains or profit from the realization of unit as a unit holder exempted from the same amendment, and that is also removed. Third one is also a well-known one, because information technology and enabled services as prescribed by the minister exempted from 1st January 2020. So this exemption available up to 31st March 2022. Up to the end of period of assessment 2022-23, this exemption is available. You know that there is a gazette and there it prescribed what are the information technology and enabled service and what are the requirements that have to be fulfilled to get this exemption. Anyway, still there is an exemption available under paragraph U of the third schedule. There it says if you are providing service in or outside Sri Lanka, but utilized outside Sri Lanka, subject to the condition that you transferred foreign currency from foreign bank to Sri Lankan bank, you are having an exemption. So simply we can identify as a service export. So service exports still exempted. Say if you are providing information technology services also as a service export, still you can claim that exemption, but this one not available. So information technology services provided in Sri Lanka is not exempted no after 1st April 2023, but to outside Sri Lanka still exempted under paragraph U. Then as a policy of government from 2021, government has introduced certain exemption to promote TVET concept. Accordingly, educational establishment who are following TVET concept and registered with the Territory and Vocational Education Commission, they granted 5-year exemption. In order to get this exemption, they have to increase their student intake in first year of assessment compared to the previous year of assessment by 100%. They have to double their student intake, and they have to maintain that doubled student intake level to another 4 years. Accordingly, they received 5-year tax exemption period. So this tax exemption period limited to 2 years from this amendment. So if you are a educational establishment receive this benefit, you have to double your student intake in 2021-22 compared to the previous year, and that double portion has to be maintained for 2022-23, and based on that fulfillment of those conditions, you can get the exemption for 21-22 and 22-23. Thereafter, exemption is not available. Then another exemption granted from previous amendment with effect from 1st April 2021 for gains and profit for on export of gold, gems or jewelry, cutting, polishing including cutting and polishing. So that exemption also available up to the end of year of assessment 2022-23. So also available up to 2 years. Then business gains and profits from undertaking of warehouses conducted in Galle and Colombo airport. So this exemption is also granted based on the 2021 amendment to develop Galle and Colombo airport premises. But this is also removed with effect from 1st April 2023. Then 5 types of tax holidays granted through the 2021 amendment based on the 2021 budget proposals. So all these tax holidays are closed from 1st April 2023. So if you are a person who has completed your project according to the conditions prior to this date, you are still eligible for these tax holidays. But new businesses on or after 1st April 2023 are not qualifying for these exemption. First one has been granted to develop materials used in the construction sector to recycle in Sri Lanka. If you are a person who is conducting a premises or the business to recycle your construction sector use materials, exemption has been granted for a period, and that period is not available from this amendment. Thereafter, the second one is for people who have started businesses after following TVET courses. As I said, there was an intention to promote vocational education in Sri Lanka. Accordingly, exemption granted to educational institutions. Not only that, another 5-year exemption granted for individuals who have followed those courses. So if they have successfully followed their TVET courses and started a new business, 5-year exemption period granted, and that 5-year exemption period is also not available thereafter. If they have started a business and enjoyed this tax holiday, they can continue. Third one is has been granted to develop manufacturing boats and ships in Sri Lanka. In order to promote tourism sector, this has been granted. So local boat and shipping building businesses, this has been granted. Therefore, it's available only for 2022-23. New businesses are commenced after that year of investment. It's not available. Exemption granted for 7 years, but from the commencement of 1st April 2023, it's not there. Then renewable energy project, which are having more than 100 megawatt capacity, granted 7-year tax holiday. I think there were 2 projects intended to commence and do this business. So I hope that those 2 businesses already completed their project. So if so, they can get that benefit. If not, from 1st April 2023 onward, this is not available. Then there was another policy of the government to promote communication to village, and accordingly, communication towers and related appliances promoted an exemption granted for a 5-year period, and that exemption is also withdrawn. Then I am moving to discuss about the dividend taxation. Prior to the amendment, dividend payments by a resident company received from another company or pass-through dividend exempted, and that exemption withdrawn from 30th September 2022. So therefore, another exemption granted accordingly, that is the 4th one. There it says the prior year, the pass-through dividend should be subject to AIT under section 84(1)(a). So there is a matter for the pass-through dividend as well. Suppose that you received a dividend prior to 31st December 2022, and it's not subject to advance income tax under the changed provision. So it's not subject to 15% because 15% withholding rate introduced after 1st January 2023. Therefore, you will face a problem how you can distribute this because it's a pass-through, but it's subject to tax. So considering this implication, as I said, there were 3 proposals in budget 2023 under technical note. So now there is a proposal to remove the condition available in the 4th item. So I have highlighted in blue color. The proposal is to remove that part. So now after the relevant amendment, whether the relevant dividend is subject to AIT or not, you can consider all pass-through dividend as exempted once that proposal incorporated as an amendment to the Inland Revenue Act. Second one is dividend declared by resident company to a non-resident person. It's exempted up to 31st December 2022. That is, it's available only up to 30th September 2022. There are also another gap from 1st October 2022 to 31st December 2022. So that matter also answered through that technical note. Fourth one is dividend declared by commercial hub entities. It's available even after this amendment. Then I have discussed about the changes. So now a matter is available. How you can compute your income tax payable for the year of assessment 2022-23. We have another experience in 2019-20. There gazette has been issued by the Commissioner General specifying how you can compute your income tax payable. But this time, all conditions mentioned in the Inland Revenue Amendment except. So there it says how you can compute your income tax payable for year of assessment 2022-23. The period are also different for individuals and other person. For individuals, all changes made from 1st January 2023. Therefore, first 9 months prior to the amendment, statutory provisions are applicable. For second 3 months period, after the amendment, statutory provisions are applicable. For others, I mean for companies and others, they have to apply 6 months and 6 months. First 6 months prior to the amendment statutory provision, second 6 months after the amendment statutory provision. So you are having sources of income, employment, investment, business, and other income. From those 4 sources, employment, investment, and other income, you have to consider under actual basis. If you receive employment income during the first 9 month period, you can't put that amount into second 3 months, because according to the actual basis, you have to put into the first 9 months. Say your fixed deposit matured in first 9 month period, then you have to put into the first 9 months. Say if your fixed deposit matured in second 3 months, you have to put into the second 3 months. Likewise, employment income, investment income, and other income, you have to use actual basis. But for business income, it's optional. Depending on your choice, you can use actual base or pro rata base. You can compute the business income, and if you are in a position to compute your actual business income by preparing a separate financial statement for first 9 months and second 6 months, you are allowed to do that. If not, you can compute your total business income and then can segregate into 2 parts by applying pro rata basis. So there will be certain matters. I think this choice has been granted considering this one. Say one taxpayer has asked from me for first 9 months he received a profit, and second 3 months he received a loss according to his estimate in his company. But his question he asked is whether the loss earned in second 3 months he can carry it forward to next year and deductible. I think it's a decision of your choice. First, you have to decide whether it is beneficial to carry forward that loss to next year, because considering the time value, you can decide. If not, you can simply compute the total business income or business loss for the year of assessment and can apply the pro rata base. So choice is available. Anyway, the department is expected to provide an example and explanation to compute your 2022-23 year of assessment tax computation, because as a explanation, I think it's better to provide it. Then the payment of income tax. As I said, the company tax rate changed after 6 months. So they could make their third installment payment due on 15 February 2023 based on the new proposal, because for 6 months due tax due quarterly installment you already paid in 15th of August and 15th November. Now, after the change, your third installment is due on 15th February and 15th May on fourth installment. So if you supposed to revise your estimate, you can provide it based on this provision. If not, you can simply compute your tax liability and can make payment. So my income tax related explanations are over. Anyway, there is only a few value-added tax changes. I will explain that part as well. There are the first change is value-added tax registration threshold. You know that it increased from 1st January 2020 to rupees 300 million. Now that has been reduced to rupees 80 million for an annum or 20 million for a quarter. So based on this registration threshold, if your taxable supplies exceed this registration threshold, department has already published a notice to register with the Commissioner General. If you postpone your registration, you will be liable to pay penalties under section 66 and 767. It's another matter, but if your taxable supplies increased comparing this threshold, you have to register. But still, the voluntary registration is also there. Say your taxable supplies is less than this threshold, still you can ask for a registration based on the voluntary registration. The second one is supply of condominium residential accommodation. You know that the exemption available according to the prior to the amendment, withdrawn from the Act number 44 2022. Therefore, with effect from January 1st, 2023, supply of condominium residential accommodation liable for VAT. Whatever the payments made prior to this day is also not liable. And when you are computing liability, section 5 says market value of the land also could be removed. So explaining the position of the department will issue how you can compute your output tax on the supply of condominium residential accommodation in future. Third one is VAT rate increase with effect from July 1st, 2022. It increased to 12% from 88%. And then it again increased to 15% from 1st October 2022. So those are the things that I have to explain. I think my presentation is rather lengthy, but I wanted to explain all these withholding provision. That's why I have taken much time. Thank you for effective listening.
Ladies and gentlemen, let's take a quick tea break. Quick is very quick. So let's take within 10 minutes, we should be back after having a cup of tea and refreshments. You have to climb one stairs, one floor up here, from here. It's just at the entrance, we have provided food. Please go, quickly come back, and washrooms are on this side. We are expecting you in 10 minutes. Thank you.
Without, they can deduct. That means withholding agent, that means employer can deduct withholding tax without your consent. That is the new concept of the APIC. Yes, it is not moving. Okay, as I explained, now when an employer making the payment to employee, definitely they have to deduct withholding tax, that means EPIT from their employer. When they are deducting their EPIT, there are tables. Those tables are published by the Department of Inland Revenue because when they are deducting, it will be a very difficult thing because there are a lot of tables. There are different types of income. Therefore, different tables are there. Using those tables, employer can deduct the EPIT from the employee. There are 7 tables. I think all of you know about that. We have provided new tables. Those tables are relevant for these 3 months, the newly published tables. Those tables are relevant for only this 3 months period because we have year of assessment 22-23 period. Changes will be made with effective from January 1st, 2023. Therefore, for the 3 months period, special tables have been provided by the Department of Inland Revenue. You can use those tables to deduct EPIT. To facilitate the employers, there are guidelines. Those guidelines are also issued by the Department of Inland Revenue. You can follow those guidelines. According to those guidelines, there are 7 tables. You can use those 7 tables when you are deducting the employees' advanced personal income tax. So there are 7 tables. Table 1 for the monthly, table 1 for the regular profits. Regular profits means Table 1, you can use table 1. Table 1 is applicable for all residents. That means irrespective of whether they are resident or non-resident. But for the non-citizens, this table is not applicable because table 1 is prepared with the tax relief. That is why we are not using this table for non-resident, non-citizens. We use this table for residents and non-resident citizens only. And if we have considered the monthly tax relief when we are preparing this table. Therefore, you not need to deduct tax relief when you are calculating the EPIT from your employee. Only thing you have to do is you can apply this table for their monthly income. What are the regular profits? Regular profits means the income we receive from our employer in regular basis. That means salaries, wages, OT, and all other things. All are regular payments. When we are receiving regular payments, our employer can deduct EPIT using this table 1. It is very easy. Table 1 is there. This is just a summary of the table 1. There is a huge table. I think around 65 pages are there. Using that table, employer can deduct EPIT from the employee. This is the summary of the table. You can see the first line. There is a monthly regular profits from employment up to 100,000. It is relief. That tax relief also granted when we are calculating the table 1, using the table 1. That is why I said that when you are calculating, when the employer calculating an employee's income tax payment, not need to deduct tax relief separately because it has already been considered when the preparation of table 1. This is the table 1. You can see this table. You can download this table and you can download the guidelines from the department website. There are a lot of examples in the guideline. You can follow those guidelines. I think it is very convenient for you to apply. Then I'm going to explain about the table 2. Table 2 is applicable for the lump sum payments. What are the lump sum payments? Lump sum payments are not the regular basis. That means salaries, wages, OT, and other allowances, all are we receive on regular basis. But sometimes we receive some payments once a month, once a year, once a 6 months, like that. For an example, incentives or bonus. If we receive incentive or bonus, we cannot apply table 1. That is why we have prepared special table to apply for that lump sum payments. If you have lump sum payment, your employer will deduct that tax on that lump sum payment using this table 2. When you are applying this table, there are special things to be considered. That means you have to calculate estimated gross aggregate remunerations, because you will receive regular profits and that lump sum payment together in 1 year of assessment. Because of that, special amount should be calculated. That is called estimated gross aggregate remuneration. When you are calculating that estimated gross aggregate remuneration, you have to add gross monthly remuneration already paid, and the gross monthly remuneration payable. And another one is the lump sum payment you received and you will receivable during the period. After deducting all these remunerations, you can calculate EGAR, E-G-A-R, estimated gross aggregate remuneration. You can find this calculation in the guideline. We have provided that guideline. Very easily you can calculate this remuneration using that guideline. After that, what you have to do, the D means the EGAR. You can consider the value of EGAR and you can apply that EGAR to the relevant bracket. There are several brackets. You can apply that bracket, relevant bracket, to calculate the relevant deductible EPID for that lump sum payment, not to the total income received by that person. For the monthly regular profits, table 1 is applicable. For the lump sum payments, table 2 is applicable. When you are calculating the lump sum payments tax, you have to apply table 2. After applying table 2, what you have to do, you have to deduct payments made using that table 1. That is why that formula is given. After applying that remuneration to that formula, very easily you can calculate the payable tax for the lump sum payments. I think our time period is very limited, therefore I am not in a position to explain all the calculations now, but there's a formula. You can apply that formula and you can include all details to that formula. Then you can calculate the deductible tax for that lump sum payment. This is an example for that. Mr. Fernando receives, Mr. Fernando, he is a resident employee of PQR company. He received bonus. Bonus is a lump sum payment, not the regular profit. This person received regular profits plus lump sum payments. Now we are going to calculate the payable tax for that lump sum payment. How do we calculate? We have 2 steps to be followed. Step 1 is to calculate EGAR. EGAR means estimated gross remuneration. So to calculate that one, we should know our regular profits, payable and will be paid in future. Both we have to consider, and the lump sum payments made and will be received in the future. All details should be there. Using those details, we can calculate EGAR. After that, we have to follow step 2. Step 2, after calculating that D, we can apply that D to the relevant row of the table. The formula is there. It says D into 18. D means the IGA. So we have to apply 18% on that. Table is provided that. These are not my figures. All tables are provided in the website. So only thing is we have to calculate real amount, real remuneration, actual remuneration. After that, that actual remuneration should be applied to the relevant formula. So that formula is provided in the website under table 2. So D means that IGA, then the applicable rate for that part is 18%. After applying that part, we can deduct all the taxes paid up to now. After that, we can calculate the tax on that lump sum paid. If you have any questions regarding these examples, you can ask during the session. Then tax table 3. Tax table 3 is applicable for once and for all income. What are the once and for all payments? Those are terminal benefits. That means when we are retiring, when we are ceasing our employment, then we receive several income. That for that income, we have to apply table 3. These tables are not applied by the taxpayer, but the employer. When they are making their payments to their employees, what they have to do? They have to deduct tax using this table 3. When they are making this, when they are applying this table 3, there are special conditions to be fulfilled. If that this income, when making these payments to their employee, some payments are taxed at the concessionary rates. Some payments are taxed at the higher rates. Higher rates means normal rates. Because of that, that employer should segregate these two income into the concessionary rate income or higher rate income. If that is a concessionary rate income, I think all of you know about this income because this is not the new thing. These all are very familiar thing to you. These payments are very familiar to you because we have started this pay system with effect from 2018, April 1st. Therefore, you know about this. Only the name change for the withholding tax and APIT, only the name change, not the content is not changed. So table 3 is applicable for the once and for all payments. When they are making once and for all payments, some payments are taxable at the concessionary rates, some payments are taxable at the normal rates. So we have to segregate those income, those payments. If that income are taxed at the concessionary rates, then the employer, what should that employer do? When making the payment to the employee, that person should retain 5 million rupees with the employer and balance should be paid to the employee. What are the income, what are the payments that are taxed at the concessionary rates? Those are amount payable in commutation of a pension. Another one, amount payable as a retiring debt gratuity. And the next one, amount received as compensation for loss of office or employment under a scheme which is uniformly applicable. There are a lot of schemes. Those are not uniformly applicable to all employees. If the special scheme is uniformly applicable to all employees and that is approved by the Commissioner General, that kind of payments also taxable at the lower rate. And the next one is any sum payable from the employee's trust fund, excluding the investment part, that means interest part, because interest part is exempt. That is why we have not considered that. If an employer making this kind of payment to their employee, what that employer should do? Employer should retain 5 million with him and the balance can be paid to the employee. Then that employee should obtain a direction from the Department of Inland Revenue within 90 days. After obtaining that direction, that employee should furnish that direction to their employee. Then what that employer should pay the balance part to the department from the retaining part, and the balance part should be paid to the employee. If there is a balance payable to the department, that part should be paid to the department. And if there is a balance to the employee, that part can be released. I think all of you know about that. If that employer is making the payments to their employee, which are taxable at the higher rates means normal rates, then that person should retain (36% on any following payments. That means these payments are taxable at the normal rate. That is why he has to deduct 36% on that, and the balance part should be paid to that person. Then finally, the employee should obtain a clearance, declare a direction from the Department of Inland Revenue. That direction should be forwarded to the office, his employer. Employer can release the retained money to the employee. This is the way this retaining part will happen. So that person should apply table 3 when the employer making the terminal benefits to employee. For the concessional rates also provided in the new Inland Amendment Act, but it is not changed. Concessional rates are provided in the Act. That rates are not changed, remain unchanged from the previous amendment. For the first 10 million, that is not taxable. For the next 10 million, concessional rate is 6%, and for the balance, applicable rate is 12%. So for the terminal benefits, if that terminal benefits are terminal benefits are taxed at the concessional rates, these are the concessional rates applicable for those terminal benefits, which I have explained earlier. Then table 4. Table 4 is applicable for non-citizens. Non-citizens means there are non-residents in our country. For the non-resident citizens, we can apply table 1 or table 2. But for the non-resident non-citizens, we have provided a special table because non-resident non-citizens are not entitled for the tax relief. That is the reason we have provided a special schedule. We have calculated this schedule without granting that tax personal relief. That is the way we have calculated. Because of that, for the first 41,667, they have to apply 6%. This is the rate applicable for non-resident non-citizens. If an employer making the payment to a person who is non-resident non-citizen, then using this table, that employer can deduct a bit. If that person is making that employee is making the lump sum payment to that employer, again we have to calculate that lump sum payment using the table 2, method of table 2, that is provided under table 4 also. You can apply the formula given under table 4 to calculate the payment made to non-resident non-citizens. Sometimes we make payments, bonus and incentives, we have to pay to employees who are non-citizens. When a payment is made, bonus or incentives to non-resident non-citizen, then table 4.2 means in the table 4, there's a special table, that is table 4.2. That table 4.2 can be applying. Then table 5. Table 5 is also very important because sometimes we terminate our employment within the year of assessment. Sometimes we enter to the employment within the year of assessment. Sometimes for some periods, for the regular profits, we have regular profits for a month less than 100,000. But because of the lump sum payments or because of leave encashment, because of any other special allowance we receive, our income will be higher than the threshold. Then we will become taxable. At that time, we cannot use regular profit schedule because it is not regular profits. For the few months, we have regular profits. For the next months, next periods, we have lump sum payments, we have all together. Because of that, we have to apply table 5 for that. When we are applying table 5, sometimes we started the employment within that period. Sometimes our threshold will exceed within that year of assessment, not the beginning of the year of assessment. Therefore, we can apply table 5 from the first month of that they exceeding their final, their threshold, that means 100,000. Until then, they cannot apply this table. After that, they can apply table 5 or table 2 because they have regular profits after that period. Until then, they can use table 5. This is an example for that. Mr. Suraj is an employee of a private institution and his monthly regular gains and profits from employment is less than 100. In this case, he is lower his threshold, monthly threshold, that is 100,000 is the monthly threshold. So he has only less than that 100,000. But his cumulative gross regular profits from employment for the period from Jan to February is 2023 is 380. If that is 380, that means for the if that person's income is higher than the exceed 300,000, then he is liable for income tax. But for the first month and second month, his income is less than the 100,000. That is because of that, we cannot apply table 1 because he does not have regular profits for that period. Because of that, we cannot apply table 1. But within the period, his income exceeded the normal threshold. Now, his income is 380,000. Now, he exceeded his threshold. Therefore, now his monthly regular gains and profits from employment is 115,000 from March 23 onwards. That means now from March 23, his income exceeded the normal threshold. That means from March 2023, he is liable for tax. But until then, he is not liable because his threshold, his income is less than the threshold. That because of that, he cannot apply table 1, but table 5 should be applied for that purpose. The calculation is here. Cumulative gross income from January to February. Cumulative income we should be considered, that is 380,000 because for the first month and second month, he has received 380,000. But for the first month, his income is less than 100,000. Tax to be paid in February as per table 5, that is 4,800. Table 5 is provided in the schedule, in the table, in the guideline. You can follow that guideline. You can find the table in the guideline. So, applicable tax for the cumulative 380,000 is 4,801. I think it is very, tables are familiar to you. You can see the payable tax, that is 4,801. But from the month of March, now he has regular profits, that is 115,000 his monthly income. Therefore, he should apply table 1 to calculate his income. But when he is calculating, he can consider the table 1 and charge table 5 for that him. He can deduct that part. Then tax table 6. Tax table 6 is tax on tax rates. That is completely different thing. I think you know about the tax on tax. Tax on tax means that tax is whereby the employers. There are some companies, there are some corporations. The tax is paid by the employer, not the employee. Normally tax should be paid by the employee, but for some corporations or some government institutions, the tax is paid by the employer. At that time, we have to apply tax on tax rates, that is table 6. Table 6 is provided by the department with the aggregation of the payable tax. That means for that, the tax paid by the employer also taxable. Because of that, what we have to do, we have to separately calculate the payable tax by the employee, and that tax is paid by the employer. What we have to do, we have to add that tax paid by the employer to the income of that employee. Then we have to apply tax table 6. Tax table 6 provided that tax on tax rate. For the range of that income means the salary and the tax paid by the employer, both together. We have to aggregate those two income. Then after that, we have to select the relevant range of the income and the relevant rate of the relevant rate for that income. Then we have to apply that relevant rate and we have to calculate tax on tax rate. If a company bear that employer's tax, then we apply the special tax rates, not the 6%, but 6.38%. And for the next one, not the 12%, but 13.64%, like that. So that tax is bear by the employer, but for that employer should pay taxes for both the remuneration paid to the employee plus the tax. Tax on tax, that is the meaning of tax on tax. Then the next one is tax table 7. Tax table 7 is applicable for the secondary employment. Secondary employment means sometimes some employees have more than one employment. Sometimes they have more than one employment. Then for the first employment, that means for the primary employment, they can apply for the regular profits table 1. Table 1 is applicable only for the primary employment. If they have a secondary employment, they cannot apply table 1. They have to apply table 7 to calculate the liable tax. Table 7 is given in the guideline. So according to that table 7, when we are calculating the tables, applying the table 7, definitely we need the primary employment income tax range, because based on that primary employment income range, we can select the relevant income tax rate to that primary employment. For an example, if I am an employee and if I have monthly income more than within the second line range, that means within 100,000 to 141 range, then for my second employment, applicable rate is 12%. To calculate the secondary employment, for the secondary employment, we should know the income from the primary employment. Therefore, when you are submitting the secondary employment declaration, then you have to mention the income range of your primary employment. I will show you the secondary employment declaration. then you can understand what I am talking about. So this is the table 7. So table 7 should be applied for the secondary employment. If that person is a non-resident, in the second table 7.2 is provided for the non-resident, secondary employment of the non-resident, then 36% is applicable because that person is not entitled for the non-resident, even though irrespective of that non-resident is citizen or non-resident, citizen or non-citizen, 36% should be applied for their secondary employment. Then non-cash benefits, this is also not changed. You know about the non-cash benefits. Non-cash benefits means we receive benefits from our employer. Some benefits are from cash, some benefits are not the cash, they are non-cash. We receive vehicle benefits, housing benefits, like that. So those benefits we have to consider at the rate of market value. If we cannot consider, if we cannot ascertain that non-cash benefits market value, then what we have to do? We have to consider the department's circular. Under that circular, we have provided the special rates applicable for those benefits, for the vehicle benefits, for the housing benefits, and all other benefits. So you can refer this circular to calculate, to ascertain their values for the non-cash benefits. That non-cash benefit also taxable. I think all of you know about this. These are not very new things. These are very, very familiar things. If an employee has cash benefits or non-cash benefits, all are taxable. To ascertain the non-cash benefits, please follow the circular. Then what are the employer's responsibilities? Earlier, prior to 23rd January 1st, employer shall deduct EPID if the consent is given by the resident employee. If that person is a non-resident citizen, non-resident non-citizen, then that is compulsory deduction. But only with the consent, residents EPID can be deducted. But with effect from January 1st, 2023, that is an obligation to the employer. Without the consent, he should deduct EPID when he is making the payment to the employee. That is the main responsibility of that employer. Then the next one is he should find out the appropriate table. As I have already explained, there are 7 tables. When he is making the payment, he should apply most relevant tax table to that payment. Then based on that table, he has to calculate the relevant tax. Then the next important thing is after deducting the taxes in the next month, 15th of the next month, he has to pay that income to the Department of Inland Revenue. And the payment code and the payment types have already been provided in the circular. And I have also mentioned it in the document also. You can follow that. Using that payment code, you can pay that income to that tax to the Department of Inland Revenue. After deducting these taxes, what the employer should do, employer should give their employee a form T10. We call it T10. T10 is a form. It says all income received by the employee, cash and non-cash income, and the income tax, amount of the income tax deducted by the employer. Using that T10 form, employer can pay their taxes to the department if they are filing their income tax return. As Mr. Nihal explained, if that employee has only employment income, filing of a return is not mandatory because all relevant income tax is in the regular form. The employer should be deducted and that employer should pay to the Department of Inland Revenue. Therefore, nothing to be paid in excess. Therefore, it is not mandatory to file an income tax return by that employee. But if that employee wants to claim solar panel relief or rent relief, or that person has another income other than employment, then only that person should file a tax return. Otherwise, it is not mandatory. After deducting this APIT from the employee, after a year of assessment, the employer should file an annual declaration to the department, that is prior to 30th of April in the next year of assessment. Next year of assessment means subsequent period. After that, for the annual statement, that is code is 222 and 3. After that, that should be submitted to the CDMU unit of the Department of Inland Revenue. You know that. That means the annual declaration you should submit to the CDMU. And the most important thing is you have to keep those documents with you. If you have, it is compulsory to submit e-form that documents to the department. And the most important thing is if you have a, if the company exceeds 20 employees of the department, number of employees, then you have to, public corporations and others, you should use the e-services, because otherwise there are a lot of employees and these all records cannot be kept in hard copies. Therefore, we request you to submit your documents in e-form to the Department of Inland Revenue. And you have to keep all these documents within 5 years of the, for a period of 5 years with you, with your business premises. And this is the annual declaration. This is also very familiar to you. This is not for the year of assessment 22-23. This is prepared for the 21-22. New annual declaration form will be issued in due course. So it will be little bit changed, because we have two separate provisions. For the first period, for the first 9 months period, we have a consent. We should give a consent to the deduction of APIT. For the next period, it is a compulsory deduction, mandatory deduction. Therefore, two provisions should be applied in 1 year of assessment. Therefore, necessary guidelines will be issued by the Department of Inland Revenue for the preparation of annual statement. This is the T10 form. This T10 form should be provided, should be issued by the employer after deducting the employment after deducting the APIT, even though that is deducted or not. If the employer requests from the employer, then employer should give the T10 form to the employee, because using this, when that employee filing his income tax return, he should attach this T10 form. Because of that, if an employee requests from the employer, employer should give this document to the employee. This is the primary employment declaration. If a person has a, there may be a lot of employments for one person, one individual. At that time, that individual should give a primary employment declaration. This is the primary employment declaration. You can download this document from the department website. This is compulsory. This is the secondary employment declaration. When you are filling the secondary employment declaration, you have to mention the income range from your primary employment. Based on that income, your secondary applicable rate for the secondary employment will be determined. Therefore, you have to mention the primary employment income tax range in the secondary employment declaration. Thank you very much. Actually, very limited time period I had, therefore I did it very quickly. If you have any questions regarding this, you can ask. Thank you.
Ladies and gentlemen, let me invite Ms. Sarah Asker, Partner Tax Video Partners, for her comments.
Good afternoon, ladies and gentlemen. Nice to see so many known faces and nice to be back at the National Chamber of Commerce. I know we are in a fight for time, but I will harp on certain matters which are significant, and wherever things have already been clarified, I will give it a pass. So my session, I was supposed to cover VAT and SSC. Mr. Nihal has already done me a huge favor by doing the VAT part. I will just briefly touch on one of the aspects on the registration. Now, Mr. Nihal spoke about the VAT registration threshold coming down from 300 million a year to 80 million. The law was passed on the 14th of December, which means, according to the Indian Revenue Notice, by the 28th of December, the VAT registration should have been done, because of course the threshold was reduced from 1st October, but you didn't know about it, no, because the law only came on the 14th of December. So if someone hasn't already got their registration done, I would urge you all to revisit your compliance aspect of it. The second aspect is covered, so I'll move into my area, which is the Social Security Contribution Levy. Now, this is not something that came about recently. It was something that was introduced on the 1st of October of 2002. Why are we talking about it now? Because we wanted to give an overall idea of most of the tax changes that were introduced in 2022. Who is liable for SSC? Anyone who imports an article. At the point of import, the Director General of Customs would charge the SSC on the importer. Locally, if you are in the business of manufacturing any article, providing a service of any description, or you are in wholesale or retail trade, including importing and trading, then basically you are liable. So it covers pretty much the entire gamut of taxpayers, right? And now this act, I think most of you might be familiar with NBT. This is like a cousin of NBT. It's a marriage of NBT and VAT. So a little bit of past knowledge might help, although you might have to unlearn and relearn. Now the rate of SSCL is 2.5% of liable turnover. So liable turnover is a top line. All along we've been talking about income tax, which is on gains and profits. But SSC is a tax which is chargeable on the top line, and therefore you need to make sure that you have paid your SSC so far, but we look into the compliance aspect. So 2.5% of liable turnover. What is liable turnover? Liable turnover, again, I said cousin of NBT, right? Some received or receivable from liable transactions for the relevant quarter. Okay? Some received and receivable means that this particular act is going to be on accrual basis, right? So 1st of October means by now we've completed one quarter. I'm sure most of you already registered, but pardon me for preaching the converse. Okay. The turnover for the relevant quarter it's supposed to exclude any bad debt incurred by the person, any VAT paid, and any rebate under the EDRS scheme, not something that is a catch-all, but there is something called Export Development Rebate Scheme for international events that were approved by the minister. So any rebate paid under that scheme, you will be able to get or rather exclude it from your turnover. On registrations, by when should you register? What is the threshold? Interestingly, the threshold is still high enough for SSC. If you are a taxable person who is liable for registration, then you should have registered within 15 days of the date of operation. So date of operation was the 1st of October. by the 15th of October, the registration should have been made. Who is liable? Again, threshold, we have two thresholds. One is the threshold for past supplies. If as of 1st October, if you look back 12 months and your turnover was over 120 million, then you register from 1st of October. So that is the first bullet point, okay? Any taxable person whose aggregate turnover within the 12 months immediately prior to the date of operation of the SSCL Act exceeds 120 million, then you have to register for SSC. Now, you didn't qualify, but into the future, you have an aggregate of over 30 million taxable income for a quarter. Whether it exceeds, it's likely to exceed 30 million a quarter, then you have to get a registration for Social Security contribution levy. So a few things, we spoke about importing an article, manufacturing an article. We spoke a little bit about services. So there are a few definitions that I have plugged in. All of you all have a copy of the presentation material. So I'll let you all go through some of these at leisure. But article basically includes any goods, material, or any agricultural or horticultural produce. Importation is any import other than bringing it in our personal baggage. Okay, so they're not going to open up your bag and charge SSCL unless, because that's commercial quantities or something like that. Manufacture, this is very important because it's important for you to know if you're a manufacturer, because it's a little special under SSCL, okay? So manufacture means a process for making an article, assembling or joining any article, either by chemical process or otherwise, adapting for sale any article, and packaging, bottling, putting into boxes, cutting into pieces, cleaning, polishing, wrapping, etc., other than in a retail store. So what does this mean? If I go to a Sillara Kade and buy 250 grams of sugar, and that man takes it and he can't give me the sugar in the hand, no, he puts it in a piece of paper and wraps it up. So is that manufacture? What the law says is no. Okay, so other than him, other than anyone who's doing adaptation for sale in a retail store, anything else would constitute manufacture. And you'd like to be manufacturers, I'll tell you very soon why. Okay, services includes business of real estate and improvement, because I remember earlier in the NBT, there was a confusion if real estate is, are you selling goods, are you selling services? Now it has been clubbed under service in the SSC law. Person is the same definition of person as per the Indian Revenue Act. Mr. Nihal has already told us who is a person. And there is also a definition for registered distributor. Again, a very important definition, because a registered distributor in relation to any manufacturer or producer of goods means any person or partnership appointed by such manufacturer or producer for sale in the wholesale market at the price determined by him. So the manufacturer determines the price, then you are a registered distributor. And a quarter, fortunately, here is calendar quarter, so you don't have to wake your head about April, March. We spoke a lot about quarters here, but SSC, we're talking about 3 months from, ending March, ending June, etc., etc. Okay. Why was it important to know who you are? There are various taxable persons. Remember we spoke about the rate, and we said the rate is 2.5%. Right? But the rate is charged on a certain liable turnover base. Okay? If it's an import, of course, it's on the import value, so it's 100%. But if you're a manufacturer, you don't pay on the entire 100% of your turnover. You pay 2.5% on 85% of your turnover, which is why whether you are a manufacturer or not is important for that aspect of it. Maybe a reason why this has been given is maybe because under NBT manufacturers were given credits and for for the inputs, but unfortunately there is no credit mechanism under SSCL, but there is some level of a rebate or an exclusion of 15% of the turnover. Supply of financial services, those of you who are in the banking and financial sector, you take your VAT-FS value. Real estate, there is a definition or a calculation under the VAT law. You take that. If you are neither real estate or a finance service provider, and if you're someone like me, then you take 100% of your turnover as your taxable base. In the case of wholesale retailers, the law understands that margins are very thin. So if you are doing wholesale retail, it's half of your turnover is liable to SSCL. But remember, I spoke about people who are registered distributors, whose price is determined by the manufacturer. For them, there is, the law says you only have to pay on 25% of the turnover. So only on quarter. The reason is the margins are extremely thin in those businesses. What happens if you fall out of the business, business crashes or something? Hopefully none of that will happen. But if you cease your business, or if you fall below the threshold, then you can request for a cancellation of your registration after a period of 12 months have lapsed. So this is not relevant right now because the law was only introduced a couple of months ago. So, yeah. On accounting, how do you account for this? Like I said earlier, it's on some received or receivable. So every registered person is liable to pay SSCL on accrual basis, and payments are due before the 20th of the following month. So like I said, it's very similar to NBT. You pay monthly and you file quarterly. So that brings me to my next. So, yeah. Next slide. For the month of October, your payment should have gone in November. For the month of November, your payment goes in December. And the December income goes on 20th of January. And on the 20th of January, you don't just pay and, enjoy. There is also a return filing requirement because SSCL goes on quarterly returns. So every registered person shall, which means you are mandated to furnish a return to the Commissioner General on or before, basically by inviting or electronic means, on or before the 20th day of the month following the quarter. So we are almost at the end, a few days away from the end of, or rather we've already completed the quarter, a few days for the filing of the first SSCL return, and the format is already on the Inland Revenue website. Does everyone have to pay SSCL? There's a whole harangue of people who are exempted. Okay, and I can take your entire lunch break going through this one by one, or I can just tell you there are 3 categories of exemptions. There are exemptions for the first few slides, that is the first couple of slides, it's all with you, is for people, so there are 3 categories. One of the set of exemptions are for accepted articles on import or manufacture. Okay, and by and large, these cover exporters, certain imports for the purpose of exports, and certain items that are essential to the country. So without going through the whole list, I will let you all do some homework by reading it at your time. But for the purpose of completion, I have included all of these verbatim in this thing. So for example, if you import LPG gas, then that is exempt from SSCL. And if you are, say, for example, an exporter, when you export an item, there is no SSCL. So before you go for registration, and if you're getting worried, go through the exempt list and see if you qualify for an exemption. Okay. So these are all for exempted articles on importation, manufacture and selling in Sri Lanka. In addition to that, there are also certain articles which you will buy and sell. For buying and selling, there is another table. This is that table. If you buy and sell, say, pharmaceuticals or any item that is subject to special commodity levy, those are your essentials. Again, LP gas, petrol in a filling station, then again, there is no SSCL, but this list is only for those who are in trading, wholesale and retail. The first few were for manufacturers and importers, and the next couple of ones are for services. I will talk about the first service exemption because everyone got shocked about it as soon as electricity prices went up. Generation of electricity and supply of electricity other than the supply of electricity by the CEB is exempt. So CEB is liable by the SSCL Act, and that is why CEB charged us all SSC on the tariff rates from the 1st of October. There are a couple of other exemptions as well, but mostly connected to very trust industries and medical, water supply, transportation, and so on, including, of course, foreign currency service exemption, which is verbatim in the Inland Revenue Act, VAT law, and things like that. So those are by and large the accepted services. I'm rushing a little too much, but I will be happy to take any questions during the panel discussion. And I think I'll just try and save up a little bit of time because I know we overshot a little bit, but the panel deserves more questions than just SSC. So thank you very much, and thanks to National Chamber for inviting me once again. Thank you.
Ladies and gentlemen, floor is open for questions through the panel discussion. The expert panel is here. We can clarify most of the stuff. If you raise your hand, there's a FM mic that will come to you, and you can raise your question in very brief. So we have basically exceeded the time now. So we are trying to accommodate if questions are there in a very brief manner.
Very quickly, so WHD reporting tax final.
I have explained what are the final withholding payment. So I
It is
think
final tax.
no, it's not a final. There are certain final withholding payments. So in my presentation, I have mentioned, say for an example, withholding tax on dividend is a final withholding. But I think your question is focused on the interest related withholding tax. So it's not a final.
Just to add to that, I think the common problem is when you have employment income and you have the interest income. I think Madam Isabella said if you have only interest income, you can have a tax file. If you have interest income, then you need to open a tax file. And connecting to the question, withholding tax on interest is not final, is clarified also. So the interest is going to slab, which is the highest possible slab according to your universal.
Excuse me. I am having a question to Sarah SSCL. Regarding SSCL, there are items imported from which items are imported, plus things like sugar, rice, flour, wheat, and all that. But those items, 50% is liable. But only one item is liable to SSCS, only wheat only. others are not exempt.
So, the, anything that is under the special commodity area would qualify for the exemption. I'm not so sure why it was excluded.
Meat is not exempted. Other things are exempted, but
Other things are exempted because, if you go through my slides, you'll see that any article that is subject to special commodity levy. The special commodity levy is a one-time import tax charged to essential items. So that during the time you want to harvest becomes can change all the rates in only one way. And the rates and items are prescribed by the minister periodically by way of tariff. So if it is not in that list, then it would be liable to SSC. I'm not so conversant whether all the items whether it is not the special commodity.
what is in the custom declaration, there is something called the SSCL and SCL. But which is SCL is not liable for SSCL and SSCL is liable for SSCL tax.
SCL is special commodity levy. So if something is not liable for SCL, then special commodity levy, then SSCL should be liable.
So what will happen if by mistake if we have paid the tax, overpaid tax, how can we be able to get the return from the delivery?
Good question, I think that the revenue officers, because the SSCL law doesn't talk about refunds. Otherwise, I would have covered it in my presentation. So it can be carried forward. Refunds are not available minimum under SSCL Act, but can be carried forward and we can speak as advance payment.
Second one is advance payment.
One last question from me. I don't know if this is the correct forum for the subject of that. My problem with my credits. Is any delay issue with credit motions? Because Ramesh is coming now and already go to into that. There are delays in that also. And then import and export that we are facing huge.
Yes, unfortunately, our senior commissioner is not there because actually we are involving for tax policy and legislation issues. So this is also an administrative issue. So if there's any delay, we better speak with the officers of the file that file is handling. If not, we can discuss with the senior commissioner who had at the morning. Because he's under the taxpayer promotion, so he will attend on your matter.
As a private sector, very country obliged to bring up some of these questions. You mentioned that withholding tax, the 15% will apply even for the period from the 1st of October to 31st of December, although the withholding tax regulations will come from 1st of January. I know the amendment is pending, but let's assume that the amendment comes through. How will we pay the tax? Will we put it under withholding tax, fine or not deducted and pay it ourselves as a shareholder?
So I think the matter is regarding dividend tax. Due tax will not be collected as a withholding for the period from 1st October 2022 to 31st December 2022. The proposal is to provide a single tax rate as a separate paragraph of the first schedule. Therefore, dividend income, dividend declared no after 1st October 2022, but prior to 31st December 2002, will be considered as a part of your taxable income, and the applicable rate is a rate of 15%. So the recipient or the shareholder has to include dividend and has to pay tax. So that type of amendment will be there in 2020.
Thank you. So we have walked away. Silence, so I'll take a few more questions. Common ones. There are people with disappearance, 12 months to December 31st.
Yes, I think I can understand the matter. So their question is whether we can go with 9 basis or 6 basis for year of assessment 2022-23. According to section 20, subsection 2, amended by the Revenue Amendment Act number 10/2021, it says whether the company or whether the person who is unable to prepare their financial statement for the statutory year of assessment, from 1st April to 31st March, they are not in a position to prepare their financial statement for the statutory year of assessment. They are allowed to use accounts prepared for an alternative period in computing the tax liability of the year of assessment. So section 20, section 2 says you are using alternative period accounts to compute the income tax liability for the year of assessment. So there is no change in year of assessment. What you are doing is use your account set to compute tax liability of the year of assessment. You don't bring taxing rule, income, inclusion, expenditure, deductions, returns, payment, income, all are same for every taxpayers. Therefore, same basis is applicable for people who are preparing their financial statements in a alternative period. Therefore, calendar year companies also have to apply same basis. I mean, for 2022-23, for 6 months rates prior to the amendment and second 6 months rates after the amendment. So that is the position of the revenue department.
Just one last question for me. So, you spoke about revising the set. Is it a master or a that can revise our estimated income?
I think so. This set requirement, I think you have to better understand. In order to make self-assessment payment, you have to comply voluntarily. You are saying this much of income I am expecting, and allows you to provide revised estimate once your original estimate is changed according to the year period. Say your original estimate you are providing on 15th August of the year of assessment coming. But there you are budgeting whatever the income you will earn from the year of assessment. But after a certain period, you might realize that you can't get the relevant income as you budgeted. Sometimes you may find that your income is more than the budget. So for genuine taxpayers, this estimate or the set return provides to comply with the law genuinely and voluntarily by submitting a revised estimate. So this time, the year of assessment can include different period and the gross income tax will change according to the calculation. Anyway, the Act says set may file. If you wish to change your set portion, Act says, the Amendment Act says, you may file a revised estimate. But it's not a mandatory requirement. So if you wish to file a revised estimate, Act says you can file it. If not, you can maintain the previous set position and make the relevant payment at the filing stage. So there is no compulsory requirement according to the wording, but genuine taxpayers can comply with the intention of the relevant.
Excuse me. One question is regarding regulated export companies. Are there any discussions going on to reduce some concession to overseas?
I think your question is on transition rate,
Okay.
14%. Now the law is available, so at this moment, we can't change the law, but in future, I don't know if the policymakers will decide to change the law or not, especially on the game. So you can ask for a change from the policymakers, and if they decided to give it, they will consider it. But as tax administrators, now we are having the law, and for you also, applicable release 30%. The policymakers wanted to change, they come as an amendment to the law, now there is no transition.
We assume no more questions. We will conclude the session in the interest of time, because we were planning to schedule to conclude at 12 noon, and then it had exceeded almost 45 minutes. Ladies and gentlemen, thank you very much for your concern, and then it was very useful. And please look forward for similar events with National Chamber. You will be notified the similar event. Thank you very much. And then I would like to thank all the panelists and then the resource persons coming from Department of Inland Revenue and from the private sector. Thank you. Then